Thanks very much. I'm going to ask you the question to the public. How much money do you think was invested, how much VC money was invested in technology in the region last year? Any idea? Anyone? A billion? More billions? Any idea?
Below $1 billion?
Yeah. So, surprisingly, or sadly, if we take out Karim and Souk, there was only $500 million, $560 million, more precisely. This is very, very little, right? I mean, if we compare, I actually run a fund which focuses on Africa, very similar amount invested last year in sub-Saharan Africa, right? And here we talk about Middle East, so a big region. So, and we're trying to understand why is that happening? Question for you. Why do you think that so little money invested?
I think we have multiple reasons. If you maybe start from the end, if you think about how do investors actually make money, it's about getting out at the latest stage, getting a multiple on your investment, so exits. If you look who is acquiring startups in this region, we don't see yet kind of a stream of exits. If you look at the big exits in the last couple of years, it started with Maktub. Then for a bunch of years there was nothing. Then we saw, again, some foreign entities buying here. It was Rocket Internet that bought Talabat in Kuwait. They bought Yemek Sepeti in Turkey. If you look who acquired Souk, it was Amazon. Again, no national player. I think this is one of the problems that we don't see exits. And I think this will change. If you look at EMA Malls, who bought 51% of Namshi, I think this was an interesting move. And the whole move of Mohammed Al-Abar into MEVP and Noon, I think is start triggering that other bigger groups are looking into either investment or acquisition. Then we see a positive trend. We see, for example, and maybe you can tell us a little bit more about Dubai Angels. We have Women now, we had Wayne, so we have angel groups. But at the same time, for example, again, where it's lacking, if you look into the, let's say, Valley, you have VPs of Google, Facebook who left the company, who made money on stock options, and who now become angels, super angels. That's something that is missing here. If you look into the kind of private side, if you look into big family offices, they had alternatives where they can invest, either in the core, and maybe to finish it, it's also sometimes a question, do the decision makers in these big family offices and groups are experienced startup investors? Do they understand the risk class? So that is just a few reasons.
What Anvita, we're talking about now, let's think about what you get excited of, what sectors? From an angel investor perspective.
So for me, I mean, I actually came from an entrepreneurial and operational background. Before getting into investments, I was managing Dubezel and OLX, and then in Southeast Asia, which was a very developing market, full-fledged e-commerce in 7 markets, which got acquired by Alibaba. So for me, I see the perspective on both sides. I think just to first of all comment on your first question, it's how you look at things, whether the glass is half empty or half full. I see that, after all the focus has been shifting from US or India or Southeast Asia, now Middle East and Africa is one of the very potential markets. And to the numbers that you were mentioning around, the deals, the 560 million, even the number of deals that are there, right, 179 early stage investments, which is 75% increase as compared to last year, 216. So yes, I think the ecosystem is developing. It's going to take some time. Of course, there are similar challenges as when we first entered the market in Southeast Asia. There were problems of logistics, consumer behavior, payments, no support from governments or any kind of awareness. But yes, I think that the situation is changing. And in terms of the business models, I don't think so that there is any particular sector. It's exactly the underlying value proposition. Any sector can be interesting. Of course, you see a bit of shift from B2C companies towards a more enterprise B2B businesses, more shift towards disruptive tech like AI, blockchain. But there is no sector like, which is really prominent. Yes, e-commerce and fintech has seen a lot of upside in this market, but it's just changing.
Yeah, so talking about this, actually, when I look at the numbers, right, in one of those latest studies over 2017, the two biggest, 70 or 80% of the money goes actually into e-commerce and fintech here. And it's very, very surprising for me coming from an Africa investment perspective, where e-commerce is very, very small. There's a lot of money going. Fintech is big, but there is a lot of money going into health technology, into apps, into distribution, into a bunch of other sectors, and impact sectors, right? What do you think? I mean, why do you think there is so much e-commerce, so much fintech here?
Sorry?
Why do you think there is so much fintech and so much e-commerce?
These are the sectors, like, I think in any market, if you go, Amazon was like the first key player, which kind of like started in the US, and once it developed, the online sales, then you see like several other ancillary industries coming up. So was the growth story of Alibaba in China, so of Lazada in Southeast Asia. So I guess e-commerce becomes a bit of a low-hanging easy fruit to kind of convert like all the physical retail to online. And that kind of like changes the consumer behavior and gives incubation to lots of companies in logistics and payments and marketplaces and on seller side, helping in SME growth. And on the fintech side, again, they're like not like either or. The e-commerce is not going to work, right? If you don't have like integrated payment systems. And for that, like, even COD, cash on delivery, is super expensive. So yes, I think payments becomes again like, an interesting, sector, which is pretty much these businesses are primarily targeted on a large volumes as GMV or TPV, right? And to capture that, right, I think it becomes a larger penetration as some businesses which are very niche or B2B. So I guess these businesses typically kind of like attract attention in the first go.
No, it makes sense. And I think before, because what I like to get is what are we investors looking at in terms of businesses, in terms of ventures, to understand from an entrepreneur point of view, what do entrepreneurs need to be able to raise funding. So going back to your investment process as investors, Daniel, where do you start? What's your process?
I had somehow the pleasure to build up 2 times the kind of investment process. The first time when I was in Saudi Arabia building up Mobile Ventures. And now for Silicon Oasis, we also somehow, let's say, redesigned the process a little bit. Honestly, it's a very simple, straightforward stage gate process. So we have some clear gates in the process. To take you through the journey, it's simple. The first stage is what we call screening stage. It's kind of on a desk level. We review all the leads that come in the deal flow. Either we reach out or someone comes in, or I'm at a conference and someone gives me his business card. The first thing that I always request is the pitch deck. The pitch deck gets shared with the team, and if the team thinks it's interesting, we might do some background research. We might look at, let's say, wamda.com, see what will we find in general about this sector, trying to understand how big is the market, is it interesting? And let's say, in principle, we look at the deck, the team, the opportunity, and from the deck you already see how good a startup is understanding what they are doing. If it's interesting, I pick up the phone, I jump on a Skype call. If it's a startup in Dubai, maybe we invite them over to DTech, we interview them. This is the screening stage. If we say it's interesting, we move forward into the review stage. A little bit similar as the first stage, just a deeper dive. So we might say, hey, we want to understand how the cap table looks. We want to understand the kind of business plan, the Excel model, the numbers, the assumptions. We might say we want to interview more members of the core team, and so on and so on. If we still think it's interesting, we invite the startup to present to the head of the investment committee. And if they can convince the head of the investment committee, we probably, let's say, do a little bit further digging and trying to, let's say, also understand what the deal terms are. And if we, in principle, let's say, see the valuation in line with our expectation and what the potential ticket size is and who the co-investors could be. If this is still a go, we invite them to pitch to the investment committee. And after the pitch of the investment committee, we relatively quickly give a kind of a verbal commitment if we are in or not, subject to due diligence, assuming there's no negative surprises, no skeletons in the closet. But if that's it, then it's about conducting due diligence. And then depending on the type of investment, if it's a convertible, what we see nowadays quite a lot, or if it's a priced equity. If it's priced equity, for sure, it gets a little bit more tricky and complicated because you need to negotiate with multiple parties. Question is there a lead investor or not? But then the process closes. So relatively clear stage gate where we try to give clear feedback if we move forward, and in case not, why not?
Yeah, so it's a very, very formal process, right? So, Anvita, you come a bit earlier, right, as an angel. What do you guys look at? What does turn you on and off in terms of, company, team, people? What are the criteria? Because I guess you may not have all those stages, right? They may have a pitch deck, but you invest more tickets, right? You may not be able to do a due deal because there is nothing there to do a due deal on.
So, I've managed Naspers for the region, which is a growth stage investor, which is a much larger ticket size. And early stage investment is very different. What you look at different stages of growth of a company is very different. So from an early stage, I think it's a lot about management. So as an investor or an entrepreneur, you both know that this is a journey of a lot of unknowns, and will the team be able to kind of adapt or maneuver its own path as they go across the way? So I think it's very fundamental to look at the management. And then secondly, for me, it's about momentum. And momentum is a definition which is can vary from investor to investor. Some talk about numbers, some talk about growth or users. But I think what's fundamental is that as an entrepreneur, you show some kind of movement, right? Which can be in terms of partnerships or POCs or users, but you have to show momentum. And then market size is very important. Whatever you are developing as a business model or product, again, that is a key element, but how much potential it has, and that also is in respect to the competition. So yes, these are the fundamentals which you look at. And in terms of turning off, I guess I like more pragmatic and honest approach. So it's not that, coming from that background and meeting so many companies, we really know everything. We meet so many entrepreneurs and look into business models, so you have a very good idea about what's feasible and what's not. So instead of building a castle, be realistic. It's good to have perseverance, but it's also good to be, quite pragmatic. And secondly, even if the investor ends up investing into you, then be honest about the numbers or growth or challenges, because investors are there to help you, not to judge you.
No, totally. In my case, very similar things. I'm involved with a fund we come later stage, but we put tickets of $3 to $5 million in companies being around for a couple of years and making revenue. But eventually we look at the same things. For me, the entrepreneurs, the founders are the most important thing, right? Because once we put money in the business, the money is gone, right? You can have all the shareholder agreements, all the share subscription agreements in place, all the reps and warranties, whatever you want. But in my opinion, if something goes wrong in the company, as an investor, you can't do much, right? If the company goes bust, if the CEO is not good, if I need to go there and change the CEO, it means it's over, right? The effort that we put in place, the vibe which will break in those companies, in my opinion, is not fixable. So if we put ourselves now in an entrepreneur's shoes, right? So we as investors, we know at what we're looking at. If you are, and you are an entrepreneur, right? If you were to raise money, what would you do first? What are those like 3-4 key things that you try to convince the investor of?
I think what I always recommend to founders coming to us, and what I see as one of the big failures is they don't think they're building a business, they're building a product. I'm often surprised when we have founders presenting that the kind of 80% of the pitch deck is about the product. Then for sure there's a little bit of market competition in, but I often see, for example, slides where there is no team slide. I don't know who the people are. That's pretty surprising, actually. But one of the recommendations I always give is try to go as long as you can without funding. And I think it gives you several advantages. The earlier you go to an investor, the higher the likelihood that they say no, the lower your bargaining power is, the lower the chances that you might get some, I would not say really competing offers, but some kind of term sheets and commitments. So number one is don't, let's say, go to an investor with a piece of concept and then be disappointed if they say no. The further you can go, the more data points, signals you have that you might onto something. So you have developed a prototype, you have launched, you have a few customers, you have somehow figured out how do I get to my customers. All these signals give me as an investor confidence that you can execute and that you have an idea what you are doing. So this is one of my recommendations. But I also know it's difficult because people always come and say, hey, Daniel, look, I understand it's easy to say from your side of the table, go as far as you can, but I have kind of a run rate, a burn rate, so I can only sustain this for a few months. So how do I, let's say, get further? But there's, for example, also one of the observations. People often are obsessed with the product. They try to polish the product. But they never really think, okay, what is happening on that day where we switch on the website, where we get published in the App Store? And this is actually where the more interesting part begins. So if you have something that is not super valuable, but for whatever reason you're able to sell it and get people to pay for it, you might have a business. Versus you might have a Rolls Royce, but you're unable to sell it. It's not a business. So don't be obsessed with a product, and I think there is some truth in what the founders in Silicon Valley say, like Reid Hoffman. If you're not embarrassed about your first iteration of the product, you launch too late, and I think it's true. If you sit there and think about what could go wrong, I need to wait, this needs to be polished, this needs to look better, you need to launch. We had a startup where we had this problem that when he pitched, he said, I will launch in a month. And I think later on it took forever. And it's the typical mistake that you never launch. So launch, don't be embarrassed if the first version is not good. Get customers and try to sustain as long as you can. But keeping in mind, fundraising also takes time. So if you come to an investor and you say, I have 2 months left, I can already guarantee you this will not work with institutional investors anymore. You need to go to an angel.
Yeah, no, you're totally right. And I think, look, where you mentioned Silicon Valley, I think there are a lot of learnings which are common all over the world, right? But I still think that we are in a region, and I'm talking about the Middle East, about Africa, we're in regions where you just can't go and pitch an idea and, get a high valuation and get money. In my opinion, you need to have something there which makes some money, right? Even if it's far from profitability, but shows that there is a case. And then it's much easier to go and convince investors. And you brought a very, very important point. Never go, you run out of money, 2 months of cash flow, run away. and then try to raise money, it's a failure. I would not invest in a company like this. The other thing I'm looking at is I like people who understand numbers, who know their numbers. And I've seen every week I probably meet 5-6 companies from various mostly in Africa, a bit Middle East. Some entrepreneurs don't know. You ask them, what's your market? How big is your market? Some of them don't even know precisely their revenues, which is surprising. And I always go back to basics. I mean, you may know Guy Kawasaki, one of the early stage VC, over the 90s, 2000 VCs in the US, right? He has those 10 slides. Keep it very, very simple, 10 slides. So yeah, now talking a bit about the ecosystem here in terms of funds and VCs and incubators and government. What else besides the big VCs like MVP, like 500 startups? What else? Where do people can go and raise money? And obviously, it depends on the stage, right? Early stage, angels, later stage. But let's take a couple of minutes to talk about the ecosystem, the fund of the investors ecosystem.
So the ecosystem here is developing. It's not perfect. When for a startup to go out for an early stage investment, there are several options. You have now quite an active HNI, Silicon Oasis, Crypto Labs, or 500 startups, Dubai Angel Investors. There's an increasing amount of government support and awareness that's coming on early stage. The problem here lies in the ecosystem is after Series A. There's a big gap for the B or C in the market, and that's where I think the startups hit the glass ceiling. So that's one of the challenges, which is somehow have to go out of the market or convince some of the unstructured family or institutional groups for the investment. On the ecosystem perspective, right, yes, even in the Middle East, you see from also in terms of regulation perspective, not very clarity about the bankruptcy laws or, finding talent is one of the biggest issues here, but also from the mindset of the investors. Today, if I look into it, it's not about funding, it's about smart money. What entrepreneurs seek is investment, but alongside that you can really get some of the very strategic, advice or support or connections, and that's what lacks in the market. So yes, there are several challenges, but I guess the story is very easier to start, but it's going to take some time to really go up to the very growth stage.
I agree. I mean, this is something that we can't really change. And there was an earlier, very interesting panel earlier this morning where Noor Sweet from the former Leap VC was actually trying to explain and trying to understand why there is not enough money. And then she was mentioning, if you look at the US funds, right, well, we even ask, we try to raise money from pension funds, from endowments. And she was mentioning there's no really pension funds in the Middle East, right? So the funds here try to raise money from the local LPs. So finally, it ends up with family offices, with successful entrepreneurs who build their own funds, or who invest in funds. But it's pretty much everything. So we can't really change this. I would go back quickly to how do we support as investors? How do we support the entrepreneurs? What do we try to do once we invested? How do you try to help them scale, help them succeed? Because finally, right, we can live if the companies in which we invest are successful.
Sorry, I didn't get it 100%.
I said, how do we support the ventures in which we invest? How do you guys support?
You mean entrepreneurs?
How we as investors, once we invest, how do we support the entrepreneurs?
Okay, so I can only kind of speak for us, and if I look back at Mobily, maybe just on a nutshell, Mobily was the VC unit of the second telecommunication carrier in Saudi. So we wrote checks, and then we tried to unlock and give access to resources and assets of the operator. Our very first investment was Anrami, the leading music streaming company in the Middle East. And we had clearly the idea of do billing integration to bundle it with data. to bundle it with mobile prepaid and postpaid packages. So we try to give them access to the corporate resources and assets and try to leverage it, and that's the difference besides just writing a check. For Dubai Silicon Oasis, where I'm now on, where we invest, we can, let's say, help by opening doors. We are a government institution. We can help in follow-on fundraising, let's say leveraging the network of co-investors that we have and that we know. We can give exposure to startups. We have a relatively big presence on various events. But I can also personally, and I'm doing it, helping entrepreneurs drafting plans, scaling up. But for example, if I talk about, for example, Wamda Capital, they have an entire team of people who are having, let's say, critical skills in the team and then working with their portfolio companies, trying to unlock bottlenecks, like if you think about logistics, marketing. So I think have a look if you talk to investors, and also ask that question when you talk to investors: how can you help me besides writing a check? Can you help me in the next round? Can you help me with something in terms of business, corporate development?
Yeah. No, thanks. I think we're running out of time, so I'm going to wrap up. And is there any questions from the public? Okay, I'll ask one question. If you were to give one advice to entrepreneurs to raise money here, what would that be, one thing? One advice.
What I said before, try to go as far as you can without money.
Yep.
I actually have just the opposite one. I'd say go out to the investors early on, not for necessarily investment, but see feedback. There's definitely a time where there will be a right time, right metrics for an investor to get interested, but you have to keep them engaged from early on. And it's very important to have a set of mentors and board of advisors, because you cannot do everything by yourself. So
those are two advices. Thank you very much. Please, a round of applause for the panel.